Kitco Mining's special coverage of Mines and Money in Miami, Florida, is brought to you by Gold Shore.
Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mines and Money Conference in Miami in Florida. Metals prices are on a tear, and joining me to give his thoughts on why and hopefully where they may be going is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, welcome to Kitco.
Thanks, boss. Good to be back.
Now, Mike, let's start with the big picture. Where are we in the commodities cycle?
Well, it depends on which commodity. In the macro of commodities, I look at things like the Bloomberg Commodity Index. It's up about 10% this year. Like I say, it's had a good year already. But you look at all commodities, the key one that matters is crude oil. WTI crude oil looks like it's peaked around 80. And there's good reason for it to go lower with what's happening globally. There's an excess supply, decreasing demand. And now we have a very motivated administration who wants lower energy prices, and they're going to get it. They have pre-existing trends in their face. But from a metal standpoint, the best performer in major commodities here is copper. I love how my colleague in Grant Spore in my London office, who's from South Africa, calls it. That to me is a significant commodity I'm watching, and I'm really worried this rally is more of a feint rather than an enduring breakout, partly because what's happened with tariffs. So to me, that's the main one I'm watching. I think crude oil's peaked, and watching copper closely. The key thing I'll bring in about copper is this: we're on February 20th, just last week on February 14th, Valentine's Day, copper printed the high for the year so far at $4.84 a pound. Now, it did that with a major breakout between CME copper and LME copper, 10% spread, the most ever. And a lot of that's tariff related, and it flushed out some shorts and futures, and it's come back. The last time we had a similar spurt like that was when copper peaked at $5.20 last year. You see the risk there? And then we have the macro. The key thing I'll tilt over to the end with is what part of tariffs from the U.S., the world's most significant demand pull economy, on the rest of the world, most notably China, is good for this industrial metal copper. And that's what I'm worried about, that copper's more likely to go back down than stay up. Now, if it stays up, that would be great. But if commodities keep going up, and the stock market keeps going up, and cryptocurrency is going up, and unemployment is going back down in the U.S., and inflation sticky, that's an environment for Fed tightening.
Well, a lot to unpack there, Mike. One of the things President Donald Trump wants to do is, reinvigorate the U.S. economy. Copper is the industrial metal. Yeah. The U.S. isn't a big producer; it has to import a lot. A lot of the, let's say, the critical minerals rhetoric of recent years has, I think, misunderstood copper, because the refined copper, basically, most of it's refined in China, so it has to come in. The concentrates are shipped to China. With import tariffs, it does seem that President Trump doesn't really understand tariffs very well and what their impacts are. One of the things that makes everything more expensive, but it can also limit supply of critical things it needs, such as the main industrial metal. To what extent do you think that will ding the U.S. economy, the world economy?
So the key thing about, I think, understanding the tariffs is a quote I remember when I was in the Chicago trading pits almost 40 years ago, when we started with the free trade agreements and we had the Clinton administration and all things like that. And the key thing I remember using as a strategist and with my clients was, everybody in the world wants free trade as long as they can have a trade surplus with the U.S. Now, the book by Robert Lighthizer, No Trade is Free, is kicking into what Trump believes in, that there has to be an offset to this demand pull economy that is, the base currency and provides freedom and provides the safety of the seas for the world. That's shifting. So there's certain relevance to tariffs, but what you pointed out is a short-term function. There's a decent amount of copper that can be produced in the U.S. As far as the demand pull, the key focus is China. So when I look at copper, the key thing I like to outlay with copper is right now it's around $4.60 a pound. If you take that price to convert it to a percent, it's basically the same price as U.S. Treasury 10-year note since 2015. It's just that trend. Copper is very synonymous with interest rates. And also, if you overlay it with the Chinese 10-year note with this 1.7%, there's a tilt towards global deflationary trends from global sovereign bonds. To me, that's the key thing to watch. And so for copper, U.S. demand is not significant as far as U.S. industrial production really kicking in. Yeah, that's going to help, but it's really China that matters. And China is, via the bond market, showing severe deflationary forces. So to me, that's the problem. And so I look at copper as over time, the highest close ever we had for the dollar price of copper was $4.75. And that was March of 2022, right after the Russians' invasion of Ukraine, who was quoted as the decisive enabler of that invasion was President Xi, according to NATO. Right, and so last week it popped up to 484. If it can stay above these levels, it's meaning something. But in the macro, I think U.S. demand is insignificant. It's China that matters. And I look at China as some combination of the Soviet Union and Japan about 30 years ago. GDP in Japan at $4 trillion is the same as it was about 3 decades ago. And their demand for crude oil has declined. That's where we're heading in China, in particular with these tariffs kicking in. So I look at copper's, yes, electrification, I get it. Decarbonization, I get it. I do think copper's going to outperform crude oil over time. It has been most of the time, but we're bumping up against really good levels facing these tariffs. And I just look at it, it's February. We popped up for tariff scares, and it's just one of those things I noticed in the future. So I'll end with this. Last year, copper popped up from around 4 to 520. And it was based on one key fact: massive speculation in futures. Managed money net positions in the LME and CME jumped up to 32% of total open interest, and it's come back. Now that's around 20%. It's still, these hedge funds, the leveraged money is still long. They need copper to go higher. So this year it's pumped up to 484. I think it's very much similar to last year's high, and it was on the back of that major shift or that disparity between CME and LME. So I'm looking at copper, it's a commodity that has to go up, and I think it's more likely to go down. So here, I'll end with one key fact for copper is the connection with U.S. interest rates, which we have a pretty good motivated reason to make inflation go down, interest rates go down. The number one factor, I think, for the next move in copper is it's completely dependent on the U.S. stock market. It has to go up. But we're at a point now we're completely dependent and forgot about. We haven't had a correction of 10% in the stock market since Q4 23. We haven't touched a 200-day moving average. To me, that's the next key risk, because we need a little backup in U.S. stocks. There's too much optimism.
Now, Mike, presumably you're talking about 3-month copper future, that copper price rather than spot price.
Yeah, so I watch the front month futures, whatever the most liquid is. And so on the Bloomberg terminal, it's this HG1 commodity. It's just the first copper. So it's not really 3 months, it's the futures. 3 months I associate more with how it trades on the LME, which is a little more dicey. But it's at US dollar per pound price I focus on mostly. But lately, you've taken that LME price, which popped up to around $9,500 a ton, convert it to dollars to see the spread. It's just what's been relevant, because that spread broke out the most since our data going back to 1987. It's just every time that's happened in futures, you see these massive disparities when futures traders are getting hit and some of them are making money. It oftentimes signals peak. So I think we signaled a peak. If it can sustain above 475 for a while, then I'll start believing. But I need to see the fundamental backdrop, and I just don't see that coming with more U.S. tariffs.
The copper price was relatively sort of flat over the past couple of years before the breakout you mentioned earlier this year. One of the big aspects of the narrative in the copper space in the past couple of years has been energy transition demand. And during all of that, despite forecasting there's going to be, excess demand and the miners can't supply that over the coming years, it does seem, perhaps you could argue, that energy transition narrative has held back copper, distracting people from the real bread and butter factors that affect its demand and its pricing. To what extent do you think that's true? To what extent is perhaps copper now breaking away from that and getting back to its proper business?
Well, that's the key thing I think that's happening in commodities is don't underestimate rapidly advancing technology. Why do we have an excess of supply of petroleum fossil fuels and decreasing demand? Everything is going electric, which means copper and copper demand. The point is, it's a quote from Benjamin Disraeli, former UK Prime Minister UK Prime Minister, that what we generally anticipate does not occur. That's the narrative I've heard in copper for years. Electrification, decarbonization, copper will outperform. And particularly when it broke above 5 last year. And that's usually a sign like, hey, you have to be careful when the market's all tilting one way and everybody says the same thing and it goes back the other way. So that makes sense long term. It's why copper should continue to outperform most supply elastic commodities, which number one are the grains. Number two is petroleum and crude oil. It's that macro that I'm concerned about. I always overlay it with treasuries, the yield, stock market, and now we have a significant disparity with inflation in risk assets in the U.S. I mean, the most ever, which is lifting all boats, and deflation in China. So you look at the U.S. stock market blasting off, and deflation in China, not so much the stock market because they're starting to buy it with ETFs, but bond yields. I mean, I traded JGBs back in the 90s, and I've seen this before. This massive, one of the biggest bull markets in the world in the last few years has been CGBs, China government bonds. Why? Because of deflationary forces. Bond yields don't lie. Governments can make them lie. And to me, that's big picture macro for copper. Copper is the quintessential macroeconomic commodity. So if the whole world's coming out of this bit of malaise where the only U.S. is really accelerating and China's only doing well because of massive fiscal monetary stimulus, yeah, copper will do fine. But here's the key thing is, copper every day is completely dependent on more and more fiscal and monetary stimulus from China, their ability to export to the rest of the world, yet we have UK tilting to recession, Germany tilting to recession, and the U.S. dinging the rest of the world with tariffs. So I look at the macro for copper as this little feint in Q1 is more likely to be a plunge by the time it gets to 4. And here's the key thing about copper. It's one of the world's most autocorrelated commodities. It's every time it gets up to near 5, drops to near 3. Is it different this time, Paul? I hope it is, because I want to believe it, but I think it's more the situation is the whole space needs a little bit of normalization in U.S. stock market valuations. The most expensive versus the rest of the world, I can name a bunch. We all know how expensive it is. And it's just extreme optimism of the new president versus the normal tendency for markets to revert is what I'm afraid of. So the dependency is for copper's stocks starts with the U.S. stock market, has to keep going up. Yet we all know it's due for just a normal 10% correction, which typically means crude oil drops 20%, copper drops 20%.
Now, Mike, to what extent have we been here before? In the 2000s, I was living in Chile. I was a copper analyst for Metal Bulletin and for CRU. And of course, that's when the super cycle started. You mentioned the paper copper. The paper copper cycles really started accelerating then. We were talking about a super cycle. It sounds like we're getting into similar territory now. Is it a bit preliminary to talk about a copper super cycle?
Yeah.
Or are we getting into that?
I think it is, particularly if you look at China. If you believe China is going to recover from this environment, and it's not organically by being able to export to the rest of the world, an organic demand pull interior, or yeah, maybe that can happen. But I think China's peaked. Look at their stock market, look at their bond market, and look at their issue with their number one. What country brought China out of poverty? It was the U.S. exports to U.S. What happened with Japan? Exports to U.S. That has been flipped off. And it's not longer China anymore, it's one person. We have the most autocratic leader in China since before Mao. You have to go back to previous dynasties. So there's no free form of information, misallocation of capital. And where they allocate their capital to massive focuses on renewables, which makes some sense because they don't have the energy that the U.S. has, like fossil fuels. So to me, it's the macro that matters. And what you pointed out there is when China was coming out of abject poverty, I mean, they switched to this bit of a capitalist system. I was completely going back the other way. I mean, remember what it's just not, and they're fighting, it's one person. I mean, I have to catch up on my little red book from Chairman Mao, but that's what's happening. It's just a fact what's happening. The thing is, they just pissed off the world's most significant demand pull economy in the world, the export stuff. Sorry, but it was only going to last so long. It's switched off. And my point is, every day that goes by, you have to watch what's going on in China, particularly bond yields. Demand for crude oil. Exports, imports from China of crude oil peaked around 11 million barrels a day. It's ticking lower. Japan did that same thing about 30 years ago. So to me, it's all about China. China's in a malaise that's going to last a long time. If they come out of this with a historic shift that means the past patterns don't repeat, then we're okay. So I'll end with a book by Edward Chancellor, The Price of Time, pointed out every time in history you have these massive punts in liquidity, which China did in a big way. You always have deflationary forces kick in. That's starting to happen there. What changes it? Probably not tariffs from the U.S., probably not what they're doing now, and probably not UK and Germany tilting towards recession. I mean, one of the biggest trade issues was trade transfers was Germany and China. But what's happening in China? I mean, have you seen these BYD vehicles? I have a 10-year-old Chevy Volt. It's a plug-in hybrid, and these BYD vehicles are half the price, much better, and they're just crushing the rest of the world in terms of exporting deflation. And they have to do it, and the rest of the world's pushing back.
Yeah, superior technology. Okay, Mike, let's switch the red metal for the yellow metal. The gold has also been on a tear. I believe it made more than 40 all-time highs over the past year. Why is gold making such a frenetic pace?
It starts with one date, February 4th, 2022. President Xi and President Putin declared an unlimited friendship. That shifts the world order. Since that date, the actual spot gold price is up about 65%. The total return at S&P 500, it's maybe 40 and change, 40%. So gold is beating the S&P 500 on a 1, 2, and 3 year basis today, February 20th, 2025. Question is what shifts that? Now, maybe Mr. Trump will save the world and shift it, but the world order shifted. And the key thing I want to point is the number one thing about gold is my colleagues in London, like I mentioned, Graham Sworey pointed out, gold's basically expensive versus everything except one key thing. It's historically very cheap versus the S&P 500 versus the stock market. And to me, that's the next thing for gold. So gold's bumping up against good resistance around $3,000 a pound. An ounce. And we all know gold has a tendency to hang out around round numbers. Remember, it got to 1,000 right after 9/11. After 2009, it hung out around about 2 years before it broke up to 1,900. Then it pops up to 2,000 in 2020, and it took 3 years before we go to 3,000. So we're near 3,000, but it's getting stretched on almost all measures. So I'm really worried about gold getting expensive. And the question I'd like to ask you is, do you know any strategists that are bearish gold?
No.
Exactly. Everybody's bullish now, which is great. So people like me who are early, and some people would say wrong, admitted, I'm just a sayer now. I don't do it anymore. I mean, I'm long-term investing. I don't trade it. I mean, I bet, and when it pumped up against 2,000 for 20, 21, 22, I kept saying, yeah, it's a matter of time it goes to 3,000. Yeah, McGlone, you've been wrong. So finally I got it right. But now I'm worried about, so the key thing I like to point out about gold is ETF holdings. What's been supporting gold? Central bank buying. On the back of the unlimited friendship, what they quote is de-dollarization. Well, there ain't no fiat currency on the planet. It's even close to a 10 on a 1-10 basis. Gold, dollar's a 10, maybe the euro's a 5. The yuan's a 4, and Swissy's in there, and the yuan, it's not even in there. I mean, you can't trade it. The key thing is ETFs investors, your average, let's say, American investor, hasn't cared about gold. The rock has been beating stocks for so long they don't care. For 4 years in a row, we've had ETF outflows from gold. Peaked around 20. That, I think, make a call, McGlone, is going to shift this year. And the number one thing to get your average investors been making a killing in NVIDIA and stocks, and with U.S. interest rates high, is when they start giving up a little bit on this unstoppable U.S. stock market. That's what kicks in gold. Now, initially, if the stock market corrects, as we found out in 2008, gold collects a little bit. It's not profound to point out there's going to be a period of underperformance in equities, and that to me is what catapults gold from 3,000 to 4,000. It's just going to take a time. We need a period from some normalization in the very lofty U.S. stock market, but that to me is what gold's signaling already by outperforming, by the rock outperforming stocks for 3 years now. To me, it's signaling it's on a tear. It's going to bump up against 3,000. It's going to hang out there for a while. Very good resistance, but to get it to the next level, you need to have a little give back and the alternative, which is the unstoppable U.S. stock market for now.
You've mentioned in your comments there about US President Donald Trump, and he's disrupting a lot of things, and there's a lot of talk in the gold space about disruption in the gold space. There's talk of, will Trump usher in a new gold standard? There's talk about auditing the US gold reserve, Fort Knox. Would that be good or bad to know how much gold is there? What are your thoughts on those things? Is a new gold standard possible, feasible, desirable?
No, it's silly. It's one thing I love about being in the gold space, Paul, is when you go to gold conferences, and metals conferences, get a lot of the gold bugs, and they say things like that. Scott Bessent was on a Bloomberg interview this morning, pointing out the gold is audited. It was audited last year. It's there in Kentucky in Fort Knox, and it's just silly to say it's not. But I mean, we're just not that much of a conspiracy type of thing. But gold people like to say, I'm still bullish gold. That I'm not worried about. He said that's unlikely. We've gone past that. The most important thing is to stabilize the solidity of the U.S. dollar. I mean, you got to have a fiat currency, and it's not cryptocurrencies, and the dollar is it. So I'm not worried about that. I think that's kind of things you hear from gold bugs. If you want to get extreme people, Bitcoiners or crypto people are just as extreme as gold bugs.
Well, that's not good.
We don't have to go. But I have to mention that because and I'm glad you mentioned, because you can't mention gold anymore without mentioning Bitcoin in the same space, based on what's happening with our president. Flipped from, they say there's no zealot like a convert. He converted from antagonist to be popular with cryptocurrencies. Last year, we had the most significant ETF launches in U.S. history, and those for Bitcoin and cryptocurrencies, massive inflows and outflows in the old rock. So here's a quote, the term I've learned from the crypto people is boomer rocks. That's what your typical 30-year-old doesn't care about gold, but they will, because I'm thinking it's not going to be the gold standard, and it's not going to be a Bitcoin standard, because the dollar is the best way to transact ever. You don't want to sell your gold. You don't want to sell your Bitcoin. But the point I'm making is there's so much enthusiasm for these highly volatile, speculative digital assets that's pushed back in gold. To me, that's part of that massive wealth creation we had, a part of the massive speculation that is very dot-com bubble-ish. When that reverts, and I didn't say if, that's where gold shines, potentially with Treasury bonds.
There does seem in the gold space and in the cryptocurrency space, there does seem to be a lot of people talking their own book to presumably, hopefully, try and get higher prices. Now, you mentioned about the ETFs. In January, neither the GGX nor the GDXJ had a single day of net inflows. Indeed, the GDXJ has seen no inflows for 3 months, with $495 million of net outflows over that period. Why haven't the gold companies performed? And will this be the year that they do?
So that is one of the key questions, Paul, I've been concerned about for 3 years now. So this is the third annual mining and money conference. And every single time I've been in a panel, that's the first thing that's brought up. And I focus less on the underlying equities. I stick with the commodity. I think it's going up. What concerns me is I think it's part of what's happening with the technology of gold. It's harder and harder to produce it. It's very one of the most dirty things to produce. And the profits are harder. So I'm concerned is when you don't have the underlying equities for major commodity like gold, when it underperforms, when the stock market, which is beta for equities, is making record highs, what happens when beta pulls back? We're overdue for some deflation in beta. And I say deflation because in commodities, inflation is when they go up, deflation is when they go down from a peak. That is what I'm worried about. So I'm sticking with the underlying in that. And I mean, I get people wanting to be involved with the equities. I'm just really concerned about what it's signaling. But to me, it's part of what's happening potentially with the technology. And that's one thing I've learned in commodities. Number one, commodities overall, with the exception of gold, they are the most correlated assets on the planet. Why is crude oil $70 a barrel? Because it went to $130 in 2022 and created a lot of supply and reduced demand. Elasticity happens in every commodity over time. People forget that. And gold's the one exception, but when you get to a level like 3,000, I just remember it popped up to 1,200 in 2008 and 9, and I just remember driving around Connecticut. We're in Miami now. Is every place I would see was, recycle your gold, recycle. It comes from recycling. So I think that's going to happen once we get to 3,000. But the equities, I'm still perplexed by that. And I'm curious at this conference what they tell me. And the thing is, it's been 3 years now. They're still underperforming.
Absolutely. We're in the middle of 2024 financial results, and it's a bit of a spread across the board. Costs are still increasing pretty much across the board, which I imagine is a key concern. But despite that, the high gold prices means a lot of companies are enjoying an all-in sustaining cost margin of in excess of $1,000 per ounce. So hopefully, presumably, there'll be some performance coming to their share prices later this year. Mike, 2025 is ahead of us. So to end, what do you think will be the key themes to look out for this year in the gold space and in the copper space?
The number one factor for all markets is when you have the U.S. stock market running 2 times GDP, it has to keep going up. That's going to be the factor for everything. History tells us that. So last year was an example. When we have some reversion, I keep to point out we're going to have a 10% correction this year at some point. Even my colleague Gina Martin Adams, who's the equity side, who's been spot on for years, pointing out it's just too expensive. Earnings aren't there. That's going to be the most that matters for everything. Beta goes down. Now, if it keeps going up and stays there, everything's fine. But I like to point out things like last year, stock market wealth was $12 trillion in this country. That was 40% of GDP. It's the most ever. When that happens, the Fed had to stop easing. They started easing too soon. To expect inflation to go down in that environment is silly. But the way things always work in history is when those things revert, all the dominoes tumble. So that to me is going to be the number one factor. If we can get through the year without a 10% correction in the stock market, which one of us knows, who've been around for a while, and those of us who still have hair and stuff, these things used to be normal. We have to get through that period and see who's wearing their clothes. So as a strategist, I can't really get really bullish copper or industrial metals, or I'm just worried about gold's correction until we have a little bit of some back and fill in the equities. In the meantime, that's one thing I enjoy about human nature. It always happens, and everybody gets it. But as a strategist, and people when put out their calls for next year, everybody assumes one thing. You have to assume one thing: stock markets can continue increasing May at a 10% rate. So what if that doesn't happen? That to me is the number one thing that matters, and that's why I still think the next big trade is going to be U.S. Treasury long bonds. Now, I'm a commodity guy, started in the bond pits, and here's why. Because you look at yields in China collapsing. We have a very motivated government for lower energy, lower inflation. The Doge thing is significant. We're purging the world's most significant employer and cutting back in expenses. All that money is going to trickle down away from the economy. We're overdue for just a little bit of normalization. And to me, that's what's going to happen. And then I'll end with this. The average of the 5 other countries in the world by GDP, which is China, Japan, UK, and India, the average of their bond yields is 120 basis points less than the U.S. What are those bond yields telling us? They're telling us deflation is a problem. And they're facing tariffs from the U.S. Before 2008, their average was about 100 basis points above the U.S. yield. So U.S. bond yields are extraordinarily cheap on a global basis, particularly versus gold. So I'll end with this. I do a gold versus U.S. Treasury bond index ratio. We have a Bloomberg Treasury bond index that goes back 30 years. It's the most expensive ever versus Treasury bonds. So to me, that's going to be the trade.
Excellent. Well, Mike McGlone, there's a lot to digest here. I myself are going to have to watch the tape 2 or 3 times to really get full value there. Thank you very much for joining us today.
Thank you for having me. I love coming on Kitco.
Brilliant. We have a lot more to come from the 2025 Minds and Money event in Miami and Florida, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Minds and Money in Miami, Florida is brought to you by Gold Shore.